Okay, if you're a trader, you've definitely seen this wiggly line at the bottom of a chart. That's the Relative Strength Index, the RSI, and it is seriously one of the most popular tools out there. But what is it actually telling you? Well, in the next few minutes, we're going to break it all down so you can start using it with some real confidence. You know, it really all boils down to this one question, right? You see a price shooting up or maybe dropping like a rock, and you have to ask yourself, is there any gas left in the tank for this move, or is it about to turn around on me? Getting this right can make all the difference. And that, my friends, is exactly where the RSI comes in. It was developed by a guy named J. Wells Wilder specifically to tackle that question. It's what's called a momentum oscillator, which is just a fancy way of saying it measures the speed and the strength of price changes. So how does this thing actually work? Well, the most famous job of the RSI is to signal when a market might be, quote, overbought or oversold. Let's dig into what those terms really mean for you as a trader. First things first, you got to know the playing field. The RSI indicator lives on this simple scale that runs from 0 all the way up to 100. It's the movement of the RSI line inside this range that gives us all our clues. All right, the first magic number you need to watch is 70. When that RSI line gets pushed up above the 70 mark, we say the market is overbought. Think of it like this. The buying excitement might be getting a little too high and the price could be due for a break or even a complete reversal downwards. And on the flip side of that, you've got the 30 level. When the RSI drops below 30, we call that oversold. This suggests that maybe the sellers are getting exhausted, they're running out of steam, and that could create an opportunity for the price to bounce back up. And here's what that looks like on a real chart. See the price action up top, and then down below you've got the RSI doing its thing. You can clearly see those zones, the area above 70 and the area below 30. These are the zones where traders start paying very close attention, looking for signs that a turn might be just around the corner. But hold on, the RSI isn't just a one-trick pony for spotting reversals. It can also give you a really quick read on the market's overall trend. And for that, we need to look right at the middle, at the center line. Think of the 50 line as the 50-yard line in a football game. It basically separates the bullish territory from the bearish territory. So if the RSI is trading above 50, that suggests the buyers are in charge and the momentum is positive. But if it drops below 50, it's a hint that the sellers might have the upper hand.
Now, take a look at this chart. The price starts to fall, but you're wondering, is this a real trend or just a blip? Well, look what happens. The confirmation comes right when the RSI crosses below that 50 line. For a lot of traders, that cross is the signal that says, yep, the sellers are in control now.
Okay, theory is great and all, but let's see how this actually plays out in a real-world scenario. We're going to take a look at a chart for the euro versus the US dollar. So here's the setup. For 2 solid weeks, the euro is just getting hammered, falling against the US dollar. The trend was clearly down, but then look what happened. The RSI indicator finally dipped below that 30 line, entering the oversold zone we just talked about. So, what happened next? Well, the market had been falling hard, but the RSI hitting that oversold level was a major clue that the selling pressure was just about exhausted. And that was the signal. Just as the indicator suggested, the price reversed and started a brand new rally that actually lasted for weeks, a classic example. So, to pull this all together for you, here's a super simple cheat sheet. If you're above 70, you're in that overbought territory, maybe a time to look for selling opportunities. Below 30, that's oversold, a potential time to hunt for buys. And everything in between, from 30 to 70, that's pretty much neutral territory. Now, before you run off and start using this on every chart, we've got to talk about a really important warning. The RSI is an amazing tool, it really is, but it is not a crystal ball. And I love this quote from the source material because it's so true. It's important to remember that RSI is not perfect. You have to remember that. No single indicator on Earth can predict the future with 100% accuracy. You have to know its limits. So what are those limits? Well, for one, in a really strong raging trend, the RSI can stay overbought or oversold for a very long time, which could trick you into getting out of a fantastic trade way too early. Second, false signals can and do happen. And that's exactly why you should never, ever rely on the RSI by itself. Think of it as a confirmation tool to use alongside other indicators and, most importantly, your own analysis of the price itself. So is the RSI the only tool you ever need? No, absolutely not. But is it an incredibly powerful way to get a feel for market momentum and spot potential turning points? 1,000 times yes.
The key is to see it not as a magic crystal ball, but as a powerful lens. It helps you see the market's hidden strength or weakness, but it's still up to you to put that insight into the bigger picture of your trading strategy.